A dovishly hawkish Fed is causing significant market weakness. Let's get straight into it. And very, very warm welcome to our latest urgent market update video. This video is going out on Friday, the 20th of December. We were actually wanting to give these markets a little bit of time before we get this video out because there has been some important developments on Wednesday evening, just gone, which would be the 18th of December. And it may come across and seem a little bit strange, perhaps, that we refer to the Fed as being dovishly hawkish, but it's actually not a bad way of trying to summarize where we're at with regards to Fed's policy around interest rates and monetary policy more generally. So a dovishly hawkish Fed is causing significant market weakness. We're going to explain the news event, explain exactly what happened, and we'll have a look at the impact that that's had on those markets. And what are we likely to see perhaps between now and year end? We'll have a look at in a lot more detail. So without further ado, let's get straight into it then. If we can, of course, start as we always do with our risk warning, take a brief moment to familiarize yourself with our risk warning currently up on screen. And as always, be mindful of those risks involved in trading these financial markets. Okay, so first of all, let's share this news event with you. Like I said, on Wednesday, the 18th. So we're now recording this Friday morning. So Wednesday evening at 7 p.m., we got a 25 basis point rate cut from the Fed. We got economic projections which on average are certainly over the next couple of years are higher than the projections were just in September, just a few short months ago. So that's an interesting takeaway. And then we had a remarkably hawkish Jerome Powell, ironically, because he spent the last 2 years being remarkably dovish. And now he seems to have flipped. And something that I suppose a bit of a takeaway is that in September, inflation was pretty much done for the US economy. And there was no significant it didn't really feature as a major problem for the Fed in September, and it was actually moving down in line with expectations. Now we're getting a couple of, and not just in the US economy either, but across all major sort of G7 jurisdictions, we're seeing slightly more uncomfortable elevated inflation. And it's the same for the US. Now, what that means is, because if we have a strong economy, we have relatively low inflation and a strong economy in terms of growth, exponential growth. We could just look at yesterday's GDP number, final GDP numbers out of the US coming in way above expectations. 2.8 was the expectation. We saw 3.1. So the US economy is absolutely gangbusters. So with inflation not quite back to target, a bit stubborn, actually looking slightly elevated, but with a really strong jobs market, you could be looking and suggesting, why did the Fed need to cut rates at all? And this is really where the investment and trading community are at this point. And because the Fed have now, for the first time, acknowledged that sort of very, very difficult backdrop, they've kind of dropped the dovish angle, although they cut rates on this occasion 25 basis points. That's the dovish side of the dovishly hawkish discussion. However, with regards to rate cuts moving forward, we've gone from potentially 4 rate cuts in September over the course of 2025, now down to 2 potential rate cuts, but going to be very, as they call it, data dependent. So that created a bit of a panic in these financial markets, and let me share that panic with you. This is what we're really referring to. If you look at this currently up on screen, and I'll just put a nice little bearish box on it. That was the price action we've seen from 7 p.m. in the evening to the close at 10 p.m. These are all UK time. So in a 3-hour space, we were up at these highs and very close to all-time highs. And we've been in this little sideways pattern for 12 days. 2, 4, 6, 8, 10, 12 days. We've been moving sideways. And then we got this Dovishly hawkish Fed, and we saw a massive drop. Now, this is the most significant drop in these financial markets off the back of a Fed rate decision since 2001. So you have to go back 23 years before you will have seen such a significant move in these financial markets. And as you can see, it's not just in the S&P. We saw the same very significant move in the Nasdaq, same move in the Dow Jones, which had already been selling off for 10 days prior to actually Wednesday night's massive sell-off. Some further weakness across the Nikkei, the German DAX. Sorry, let me show you. Not quite as much weakness, but that weakness has certainly followed through, and we were able to book in profit on this trade this morning. We were able to sell up at these higher levels and just book in profit pretty much at these current lows, along with the DAX as well. So we saw equity markets across the world sell off the back of the Fed. That's how important they are in global economics and finance. So this is a really, really powerful move. Yesterday, what we experienced was a dead cat bounce. So we were looking very, very carefully at the price action over the course of yesterday's market. And when we got to our desks this morning, we could see the complete rejection of those highs. And we are now we've just booked in profit in the DAX. We've now got into the S&P 500, which is beginning to make a little bit of progress, and hopefully we'll close that out over the course of the trading day. So yesterday's price action was really important because it was a rejection of those buy the dip type traders that have on every sort of previously on every bit of selling, there was a reasonable amount of buy the dip buyers coming back in. Now they all came back in yesterday and they all got sort of smashed, and the overwhelming direction in these markets are very much weaker. That's not all. Let's now shift over to the Magnificent Seven, and we'll show you what these US tech stocks are currently doing. And there is let's just say that we can draw some very, very significant conclusions across some of this data. So let's look at NVIDIA, the golden boy, the poster boy really for very rampant bullish markets. Well, yesterday, if you look, this is yesterday's candlestick in here, just you can see Thursday the 19th of December. We got the selling like we did across the board on Wednesday. We got the little bounce, we gapped higher. There was a lot of positivity, and that suddenly started to unwind. But now look at the pre-market price. We closed at 130. We're currently at 127. So weakness in NVIDIA on the pre-market open. Now, if you extrapolate that across all the Magnificent Seven, so we'll have a look at Apple, you can see that yesterday, this is the only market where we actually did get a little bit of a bounce. All the other Magnificent Seven were a little bit more weaker. But the pre-market price here is coming in a couple of dollars weaker than yesterday's close. Let's flick through these seven markets. Amazon next. Weakness on Wednesday. We gapped higher yesterday, which rejected the highs, a little bit of weakness, and now we're gapping down considerably lower. And this is the important takeaway. This is the weakness that kind of underpins this market as things currently stand. Let's have a look at Meta. So sell-off on Wednesday, which is expectation. A large gap to the upside yesterday. And we were saying, look, this is this the buy the dip traders coming in? But we only just pushed a little bit higher on the open, and then we spent a lot of time selling off yesterday and actually closed lower. But look at the pre-market price. So when the New York Stock Exchange opens, you'll see all these prices drop very, very considerably. Now, the next question is, what will these buy the dip buyers do? Will they run for the exits, in which you'll see further downside, or will they effectively, and we've just had a headline, Cathie Wood has just sold more Tesla, so selling up at these highs again. But look at the gap lower it's looking like a $23 gap to the downside for Tesla. Again, a very, very bearish signal when you do this type of analysis. Microsoft, again, quite bearish yesterday. Oh yeah, sorry, we've already reviewed Microsoft, I think. So you see the weakness there again. Google, I think, was the last one. So weakness, and there's that big gap. There's that sort of $4 gap to the downside. So when we look across the Magnificent Seven, the conclusion we can draw is we are likely to see some considerable bearish market dynamics over the course of the day. And we've already positioned ourselves in those trades with weakness in the dollar as well in the pipeline. So we're very much positioned in this dollar, in this risk-off market dynamic, which is an important phase for these markets, because we are closing down for Christmas. We are broadcasting. We'll be trading live on Monday, so that's the last day, and then we're taking a little bit of a break over the Christmas period. But do keep an eye on perhaps the price action of something like the S&P between now and year end, because it's likely to give us some real useful information, all driven by this market assessing the Fed's approach to interest rates. So it's really looking like these interest rates are not able to move as low as we would have expected. So it's kind of more of a hawkish, ultimately a hawkish Fed. And the problem for that is those that are looking to roll over debt, it does mean that they have to do so now at much higher interest rates, which means the cost of refinancing debt increases, which is a bit of a problem for not just all those zombie companies that are not making any profit, of which something like 43% of the Russell 2000 is non-profit making. All those companies need to refinance debt in the coming months and years, and they'll be doing so at much, much higher prices, which could become a bit of a problem. Not to mention the US government, who are in considerable amount of debt, paying over $1 trillion every year on just refinancing their debt. Sorry, on debt repayments. They've got a lot of maturing debt coming up, which they need to refinance, and they'll be doing so now at much, much higher prices. Again, becomes a bit of a strain for the economy, because we've now got a Trump president in the US who's making a whole series of promises around cutting taxes. He's now wanting to remove the debt ceiling. All right, so look, that just hopefully breaks down this dovishly hawkish narrative, breaking it down in a little bit more detail for you, and showing the net impact of that decision making, which is significant weakness, not just in the equity markets, but in favor of the dollar, with that dollar strength and bond yields rallying as well, which is very supportive of that risk-off market dynamic. Okay, so let's wrap it up there then. Any questions covered in this session, do feel free to contact us. Just send us an email at support@thelivestrading.com and we'll get back to you as soon as we can. So listen, on that note, thank you very much for joining us. Do stay tuned for our next video. If you are interested in learning how to trade the financial markets, you can just go to our website, www.thelivestrading.com. We've got some really interesting and exciting plans coming down the tracks, which you get some information on the website on that. So from everyone here at the Live Trade Room, thanks for joining us. Take care, and we'll see you next time. Bye for now.